Okay, look at this shelf with me. 3 tablets, same model, same box, same barcode. You couldn't tell them apart if your job depended on it. This is inventory, and tonight it starts a fight. FIFO versus average cost, with LIFO crashing the party. Because here's the twist, exactly as promised at the end of Chapter 5. PixelPad bought these 3 at 3 different times, and the price climbed all year. January, $200. By June, $220. And by November, $240. Identical on the outside, 3 totally different costs on the inside. Now fast forward to December 31st, counting day. Somebody walks the aisles with a clipboard, and somewhere on that walk a scanner beeps. A sale being rung up, so tuck that beep away. We're coming back for it at the very end. And they find exactly 1 tablet still sitting there. A customer bought one in December. So which cost just left the building? Was it 200, was it 220, or was it 240? Here's what trips everybody up. Nobody knows which physical box the clerk handed over, and accounting genuinely does not care. The law lets you pick a story. 2 identical stores, identical sales, different profits, all of it legal. And the story you pick moves your ending inventory, your cost of goods sold, your profit, and the check you write the IRS. One day you'll read a company's financials and know what they're hiding. That edge starts on this shelf. So stay to the end, because the whole chapter collapses onto a single cheat card. Every method, every rule, 1 screenshot, and the printable version is free on the site. Everything tonight stands on the formula you already own. Cost of goods available, 2 exits. That's Chapter 5, linked below. But before we cost a single tablet, something even more basic. What even counts as inventory? 2 kinds of company. Then straight back to that 1 lonely tablet. So what counts as inventory? 2 kinds of business hold it, and they file it very differently. Start with the easy one, the merchandiser. Think Walmart, Best Buy, Amazon. They buy stuff that's already finished and just flip it as is. So they need exactly 1 label, merchandise inventory, 1 bucket. The manufacturer's messier because it builds the thing from scratch, and its goods live in 3 stages. First, raw materials. The basic stuff you've bought but haven't started using. Then work in process. You've started building but it's not done, half finished on the line. And last, finished goods. Done, boxed, ready to sell. Picture a kitchen, a pantry of raw ingredients, a mixing bowl, mid-recipe, a finished cake on the counter. Raw into in process into finished. Now here's the one thing to weld into your brain, because on the job, it's the first thing your manager checks. Inventory of any type is a current asset. It sits on the balance sheet right up until it sells. The second it sells, it becomes cost of goods sold, an expense on the income statement. Hold on to that placement. We'll come back to it on every board tonight. And for us, PixelPad is a merchandiser, 1 clean bucket, just like that lonely tablet from the hook. So we've settled what we own. Now the real fight begins, the one the whole chapter is built on. How do we actually put a cost on that bucket? Let's line up our options. Before we touch a single method, nail down the one thing that never moves, and this ties straight back to that bucket we just filled. The cost of goods available for sale is fixed. The only question all night is how you split that fixed cost between what's on the shelf and what got sold. And there are 4 legal ways to split it. Specific identification. Track each item's actual cost. Great for big, one-of-a-kind stuff. FIFO, first in, first out. Oldest costs leave first. The intuitive one your gut reaches for. LIFO, last in, first out. Newest costs leave first. That's a tax play when prices climb. And average cost, a blended price, goods available divided by units. It smooths out the bumps. And let's set the scope up front, so nothing surprises you later. Tonight we cost all 4 of these under the periodic system, where we count everything just once, at period end. The perpetual version, which recosts after every single sale, and can actually change the LIFO and average answers, plus how to estimate inventory when you can't stop and count it. Those are part 2. Tonight is periodic. Now here's the unlock, where almost everyone trips, so slow down with me. This is what the pause button is for. A cost flow assumption does not have to match how the goods physically move. You already live this every week. The milk aisle. The store rotates its milk FIFO, freshest jugs to the back, so the old ones sell first. But the books are perfectly allowed to assume LIFO. The jug on the shelf has no idea what your accounting assumes. Cost flow is a bookkeeping choice, not a promise about which physical box ships. Remember that milk aisle. It's coming back. So those are our 4 stories. Let's take them one at a time, starting with the most literal, specific identification. So, specific identification, The honest kid in the class. Back in my teaching days, somebody tagged the wrong cereal every single semester, and the whole answer collapsed with it. The tag is the cost. That's the entire method. You tag every single unit with its own real cost and follow it. 3 unique units. Cereal A costs $16,000, cereal B $22,000, cereal C $30,000. Say A and C sell, and B stays on the shelf. Because every unit's tagged, we know exactly, not assume, know, which left and which stayed. Remember those 3 tags, cereal A, B, and C. They're the cleanest picture of the whole chapter, and I'll call them back later. So there's no story to tell. You just read the tags. Ending inventory is cereal B, $22,000. Cost of goods sold is A plus C, 16 plus 30. That comes to $46,000. Done. No cost flow assumption needed, and it works the same periodic or perpetual. But here's the catch. It demands a record of every single item's cost. Fine for 3 arcade machines or a yacht dealer with 4 boats on the lot. Hopeless for 10,000 identical PixelPads. So the moment units are identical, we stop pretending we know which one left, and we pick a cost flow story instead. And to pick one, we need the numbers we'll write all night. So let me hand you the one data set that feeds every method from here on out. Here it is, PixelPad's whole year on one schedule, the data set I promised you. And remember the hook, prices are rising all year, so watch that unit cost column march upward. January 1st, beginning inventory, 60 units at $200. That's $12,000. Then the purchases stack on top. June 18th, we buy 90 units at $220. That's $19,800. And November 12th adds 130 units at $240, which comes to $31,200. Now total that column 2 different ways because it's the same pool of goods measured twice. Count the units, 280 available for sale. Add up the dollars, $63,000. The cost of goods available for sale, cost of goods available for sale. Write that $63,000 down and circle it twice. It is a fact, cash that actually left PixelPad's account. No method, no story ever touches it. This is the bucket for the whole chapter. Now the other half of the story comes from physically counting the shelf. The count turns up 160 units still sitting there. That's ending inventory. And notice the move. We count it, we don't calculate it. Once we know what's left, units sold just falls out by subtraction. 280 available minus the 160 counted, and that leaves 120 sold. That's the periodic method in one line. You count what remains, and you derive what's sold. And there's the whole ball game, 160 left, but at which cost? Burn that phrase in, because FIFO, LIFO, and average are about to answer it 3 different ways. 2 tiny formulas run this entire machine. Beginning inventory plus purchases equals cost of goods available for sale are $63,000. Then goods available minus ending inventory equals cost of goods sold. Everybody agrees on the bucket. The methods only argue over how to divide it. And here's where the 2 halves land. That one bucket splits in 2. The part still on the shelf, ending inventory, goes to the balance sheet as a current asset. The part that's sold, cost of goods sold, goes to the income statement as an expense. Same $63,000, 2 homes. So the bucket is set, the count is in, and we know where each piece goes. Let's stop talking and actually run it. FIFO, oldest costs out first. FIFO, first in, first out, is the first way to answer that 160 at which cost question. The rule is exactly what it sounds like. The earliest, oldest units you purchased are the first ones treated as sold. So the oldest units flow out to cost of goods, sold on the income statement. And the newest units are what's left, sitting in inventory on the balance sheet, which means whatever stays on the shelf is valued at the most recent, priciest costs. Draw it as price against time. Prices climb all year, so the cost line rises. FIFO sells off the older, cheaper end first. That shaded region is cost of goods sold, and the newer, higher end is what's left as ending inventory. Hold that picture. Cheap costs out, pricey stuff staying, because now let's actually run the numbers. So let's turn that FIFO graph into arithmetic. Same 2-step engine every method uses. Beginning inventory plus purchases is cost of goods available for sale. Cost of goods available for sale minus ending inventory is cost of goods sold. Step 1 is ending inventory, and remember, that comes from the physical count. Under FIFO, we build it from the newest units down. Grab the newest 130 units. The November layer at 240, that's 31,200. 30 more to hit 160, so we reach into June at 220. That adds 6,600. Add them, ending inventory, 37. $7,800. Step 2. Cost of goods sold is just the subtraction. $63,000 minus that $37,800, and that leaves $25,200. Notice we never counted what sold. We derived it. Don't take my word for it. Proof. Cost the 120 sold units directly. Oldest first, 60 units at 200, and then 60 more at 220. Together that's 25,200. Different method, same result. That arrow ties it right back to the step 2 number. And say the placement with me. Cost of goods sold to the income statement as an expense. Ending inventory to the balance sheet as a current asset. FIFO ships the cheap, old costs out. Now let's flip the pile upside down. LIFO, last in, first out, is the exact mirror of FIFO. The rule flips. The latest, newest units you purchased are the first ones treated as sold. So now the newest units flow out to cost of goods sold, and the oldest units are what's left in inventory on the balance sheet. Whatever stays on the shelf is stuck at the oldest, cheapest costs. Same price versus time picture, just mirrored. The rising cost line is identical, but now the newer, pricier end is cost of goods sold, and the older, cheaper end is ending inventory. Same bucket, opposite end of the pile. Let's run it. Same 2 steps, only now we pull ending inventory from the cheap old end of the line. Step 1. Ending inventory from the count, but under LIFO, we build it from the oldest units up. 60 January units at 200, that's 12,000. 90 June units at 220, that adds 19,800. And 10 from November at 240, which adds 2,400. Ending inventory, 34,200. Step 2. The subtraction. 63,000 minus the 34,200, cost of goods sold, 28,800. Proof. Newest first, all 120 sold fit inside the November layer. 120 units at 240, which comes to 28,800. Different method, same result. Now look hard at the gap. LIFO just threw 3,600 more into cost of goods sold than FIFO. That gap is LIFO's whole story in rising prices. More cost expensed, less value left on the shelf. Those fossil January costs frozen on the balance sheet. And listen, if you just watch the same bucket split 2 completely different ways, and it made sense, you're already ahead of most students. This is exactly the reasoning a future financial analyst, a CPA, a CFA, honestly, the portfolio manager or CEO you're going to become, reading her own financials, has to own cold. 2 stories down, 1 to go. But before the third, let's make sure this lives in your hands, not just your notes. Pause coming up. So let's test it. Fresh numbers this time, so you're really doing it, not just nodding along. Pause right here and try it yourself. That's what the button is for. Here's the schedule. Beginning inventory, 40 units at $50, that's $2,000. Then a purchase of 60 units at $65, that's $3,900. And a purchase of 50 units at $70, that comes to $3,500. That's 150 units available for a total of $9,400. The year-end count finds 50 units still on the shelf, so 100 were sold. Same 2 steps as the lecture. Step 1, the leftover units are ending inventory. Step 2, subtract from 9,400 for cost of goods sold under both FIFO and LIFO. Then hit play. Alright, let's check it. FIFO keeps the newest on the shelf. Step 1. Ending inventory is the last 50 units at 70, that's $3,500. Step 2. Cost of goods sold is $9,400 minus that, $5,900. Prove it the other way. Cost the 100 you sold, oldest first, 40 units at 50, plus the 60 units at 65, that's $5,900. Same answer, LIFO keeps the old list. Step 1. Ending inventory is 40 units at 50 and then 10 more at 65. That's 2,650. Step 2. 9,400 minus that. 6,750. Proof. Newest first. 50 units at 70 and then 50 more at 65. That comes to 6,750. Same answer again. And notice both methods split the exact same 9,400 bucket. Ending inventory plus cost of goods sold ties right back to it every time. If you nailed both, genuinely celebrate. You just did the single hardest computation in the whole chapter. And if you want 10 more exactly like this, the free practice set for this chapter is on the site. Link in the description. If you didn't nail it, totally fine. Rewatch the last few slides for 60 seconds. Nobody masters this on the first pass. Now, we've done the 2 extremes. So what sits in between? Meet the middle child. Average cost is the middle child. Instead of arguing about oldest or newest, it blends everything into one price. The weighted average unit cost, that same 63,000 bucket, divided by the 280 units available, $225, exactly right on the dollar. Every PixelPad, sold or sitting, carries that exact same blended cost. There is no oldest, no newest. So the graph isn't a rising split at all. It's a flat line at $225. Both the units sold and the units left sit on that same average line. No high-low split by design. Let's run the two steps. Same structure. That flat line now turns into two steps at one blended price. The weighted average is 63,000 over the 280 units. That's $225 even. Step 1, ending inventory, 160 units left, times that average, 36,000. Step 2, the subtraction, 63,000, minus the 36,000, that leaves 20. No jumps here. Read it off the board, 27,000. And it proves out. 120 sold times the same average is also 27,000. Different method, same result, and the two pieces tie right back to 63,000. Notice where average always lands, never highest, never lowest, parked between FIFO and LIFO by design. Cost of goods sold to the income statement, ending inventory to the balance sheet. And that's the family complete. 3 stories, all from one bucket. So now, let us make that difference impossible to miss. We are going to put all 3 methods side by side, and then we will look closely at exactly what moved. Here they all are on one board, the 3 stories we built, side by side at last. Cost of goods available for sale, identical across all 3. 63,000, exactly like I promised at the schedule. Ending inventory, FIFO 37,800. Average comes in at 36,000. And LIFO 34,200. Cost of goods sold, FIFO 25,200. Average lands at 27,000 and LIFO 28,800. Now watch, ending inventory and cost of goods sold move in opposite directions. Always. It's a seesaw. When prices rise, are 200 climbing to 240, FIFO gives the highest ending inventory and the lowest cost of goods sold. LIFO is the exact reverse. Average sits in the middle, and every column still adds back to the same 63,000. Just picture the one bucket again. Pour more into what's still on the shelf, FIFO style, and less flows out to cost of goods sold. Pour more into cost of goods sold, LIFO style, and less stays behind. Average splits the difference. Same bucket, 3 completely legal answers. But this is not some cosmetic curiosity. That split runs all the way down to the check you write the government. So let's push these 3 columns down the income statement and watch the dominoes fall. So here they fall, all 3 columns, straight down the income statement, right where I promised. Sales, same for everyone. 42,000. Subtract cost of goods sold, and here's where they split. 25,200 for FIFO, 27,000 for average, 28,800 for LIFO. Gross profit, FIFO 16,800, average sits at 15,000, and LIFO 13,200. Take out operating expenses, 9,000, same for all 3. Income before taxes, 7,800 for FIFO, 6,000 for average, and 4,200 for LIFO. Tax at 25%, then net income. FIFO 5,850. Average comes to 4,500 and LIFO 3,150. Same sales, 3 different bottom lines, entirely from one choice about cost flow. Trace the chain. Under FIFO and rising prices, ending inventory is highest, so cost of goods sold is lowest, so net income is highest, so income taxes are highest, and equity ends up highest. That is one single chain, and it gives you the whole picture at once. So, the trade-off is real. Pick FIFO when prices rise and you report the fattest profit, and hand the IRS the biggest check. Pick LIFO. Report the leanest profit, pay the least tax. Same company, same year, same everything. Which sets up the most obvious question in the chapter. If FIFO makes you look richer, why would any sane company pick LIFO and choose to look less profitable? Let's give that a real answer. Here's the honest answer. The real case for LIFO. It matches your most recent costs against today's revenue. And a lot of smart people call that a more realistic read on income because it drops something close to replacement cost into cost of goods sold. And in rising prices, it hands you the lowest taxable income, so the lowest tax bill, and that saved tax is real cash, still in your drawer. The catch, a big one, ending inventory can end up badly understated because those old, cheap costs sit frozen on the balance sheet year after year. Now the guardrail, the judgment call a future financial analyst, a CFA, a financial advisor, or a portfolio manager gets paid to make. The consistency concept. Use the same method period to period so your statements actually compare over time. Flip from FIFO to LIFO between 2 years and net income moves for no real business reason. Any trend analysis on you is garbage. You can switch, but only if the new method genuinely gives more reliable, more relevant information. Then you disclose it and apply it retrospectively, restating prior years. In 15 years, I've never seen a company flip methods to juice a number and get away clean. Plenty get an uncomfortable letter for it. LIFO adoption is the one exception. That one you apply going forward. So, LIFO pays less tax now and matches today's costs, but it quietly starves the balance sheet, and whatever you pick, you stick with it. This right here, knowing why a company picks a method, not just how to compute it, separates people who pass the exam from people who master the material. And speaking of mastering it, quick gut check before we roll on, because the next idea only works once this one's solid. So, gut check time, and this exact table is the one my students begged me to rerun before every midterm. Pause and try it. Prices are rising all year. For FIFO versus LIFO, mark each row highest or lowest. Ending inventory, cost of goods sold, gross profit, income before taxes, and income taxes. Give it a real shot before you peak. Answers: ending inventory, FIFO highest, LIFO lowest. Cost of goods sold, FIFO lowest, LIFO highest. Gross profit, FIFO highest, LIFO lowest. Income before taxes, FIFO highest, LIFO lowest. Income taxes, FIFO highest, LIFO lowest. Here's the one line that makes it all stick. FIFO leaves the newest, priciest units on the shelf, so cost of goods sold comes out cheap and everything downstream gets fat. That's it. And here's your gift for the exam. Average sits between the two on every single row, so you really only have to learn the FIFO column. LIFO is just its mirror. Learn 1, get 3. If that clicked, you've basically got the hardest half of this chapter locked. That's real. Take a breath and enjoy it. That instinct you just built is the same one a future CPA leans on every busy season, and you're going to be that person. Now, everything so far assumes one thing, that the ending inventory count is correct. This whole machine hangs on that one number. So the natural next question is the scary one. What happens the day the count is wrong? So, a wrong count. Look at that same formula one more time. The engine from earlier. Beginning inventory plus purchases equals goods available, minus ending inventory equals cost of goods sold. See where ending inventory sits? Right inside. So, a bad count doesn't stop at cost of goods sold. It flows straight down the income statement. Cost of goods sold, then gross profit, then operating profit, then net income. And net income lands in the statement of equity. If ending inventory is understated, counted too low, then cost of goods sold is overstated, gross profit understated, operating profit understated, net income understated. And since net income feeds equity, equity falls right along with it. Overstate ending inventory, and it's the perfect mirror. Cost of goods sold under, net income over, equity over, everything flips up. And say this part out loud, because it's the piece students forget. Net income flows into the statement of equity. Net income increases equity. A net loss reduces it. So a miscount quietly moves the balance sheet too, not just the income statement. Now the part that's kind of poetic, the reversal. This year's ending inventory is next year's beginning inventory. Same number, it just rolls forward. So the error flips its sign next period. And over the 2 years combined, total net income comes out exactly right. The errors cancel out. But each single year, on its own, still lies. That sounds slippery until you see it move on a real number. So let's do that. Pause and trace one actual miscount through 2 years. So, trace it yourself, pause, and work it. The 2025 year-end count overstates ending inventory by $5,000. What happens to 2025 cost of goods sold, 2025 net income, and 2026 net income? 3 answers. Go! Here's how it falls out. 2025, the error year. Ending inventory overstated by 5,000, so cost of goods sold understated by 5,000, so 2025 net income overstated by 5,000, profit looks 5 grand bigger than it is. Then, 2026, the reversal. That same 5,000 rolls forward and becomes 2026's beginning inventory, so now 2026's cost of goods sold is overstated by 5,000, and 2026 net income is understated by 5,000. Next year, quietly eats the mistake back. One line on why. 2025 and 2026 combined, net income is dead on correct. The error washed out, but each year on its own was wrong. That's the boomerang. If you followed that all the way around, you're genuinely thinking like an auditor now. And if you want to make it a reflex, the free error tracing exercises are on the site, worked solutions included. Alright, one last idea, and it's the one rule powerful enough to override every method you just learned. Even after you've picked FIFO or LIFO, this rule can step in and change the number. Let's meet it. So, the override. One principle sits above whatever cost flow method you picked and can overrule it, lower of cost or market, driven by conservatism. You value inventory at whichever is lower, cost or market, where market is basically net realizable value, roughly current replacement cost, boxed between a ceiling and a floor. Here's it worked, using a number you know cold. Your method priced the shelf at cost, our FIFO number, 37,800, but say market value has since dropped to 31,000. The lower one wins. You report inventory at 31,000, and that 6,800 write-down becomes an expense this period. And the placement, say it till it's a reflex. Inventory on the balance sheet as a current asset. The write-down to the income statement as an expense. Conservatism in one sentence. Recognize the loss the moment value drops. Don't wait for the sale. Bad news early, good news waits. And here's where this turns into a real edge. This is exactly the kind of footnote a financial analyst flips to first when they crack open a company's 10K. A company that writes inventory down and never writes it back up, even when prices recover, leaves a gap between cost and market. And a sharp analyst or portfolio manager reads that as a demand signal, straight out of the notes. That's the read you're building tonight. So that's the last big idea. Now the satisfying part, the whole chapter on one grid and exactly where the numbers live. Here's everything we built on one grid, assuming prices are rising. Ending inventory, FIFO highest, average middle, LIFO lowest, cost of goods sold, FIFO lowest, LIFO highest, gross profit, income before taxes, income taxes, FIFO highest, LIFO lowest, average always in between. And here's the whole secret, the one that makes tonight collapse into a single idea. Cost of goods sold is the one and only spot where the method choice enters. Everything below it just inherits the effect. So learn one column and you own the chapter. Now let's see where the two headline numbers actually live. On the income statement, cost of goods sold sits as an expense. That's our $25,200 under FIFO, and it flows down through gross profit to net income. On the balance sheet, ending inventory sits right in current assets, alongside cash and accounts receivable. That's our $37,800. Same bucket, two statements, two homes. That's the chapter in one picture. So let me hand it to you on a single card you can keep. Okay, stop and screenshot this one. The whole chapter, one card. Left, the three splits of our 63,000 bucket. FIFO, average, LIFO, everyone tying back to the same number. Middle, the rising price ladder, the inventory error rule. And lower of cost or market, write down, never back up. Right, where each figure lands on the statements. And the periodic two-step you now own cold. The printable version is free on the site, and the code in the corner takes you straight to it. Come back the night before your exam, it is the whole chapter in one glance. Now, let me close the loop on that scanner beep from the top. Look at what you picked up tonight. Specific identification, FIFO, LIFO, average cost, inventory errors, and lower of cost or market. Same 63,000 of goods, 3 legal answers. Take the win. Part 2 is next. The same goods costed the perpetual way, recosted after every single sale, which can flip your LIFO and average answers. Free exercises and the chapter notes are on the site. Link in the description. If FIFO versus LIFO tripped you up, tell me where in the comments. Hit like, subscribe, and I will see you in part 2.